Okay, we'll get started. I'll say it again, even though there aren't a lot more people here. There's been a problem with Zoom's email. Apparently, I messed something up when I added the current series of webinars. So I'm going to try and get it fixed. If I don't get it fixed and you don't get an email, you can always use the old emails and click on those links, and I think they will bring you to the same webinar. I tried it with Joao this morning, and it seemed to work, but not 100% sure how it is going forward. Hopefully, I'll be able to get the emails fixed, and then there won't be a problem. All right, so today what we're going to talk about is the fundamentals of UCO and a pretty significant change potentially in the way that we're thinking about the market. So a couple weeks ago, somebody wrote in and asked me to do sort of the same kind of presentation for UCO that I did for tallow a couple weeks ago. And I think I had done this before. I can't remember exactly how long ago I did it, but all the charts were already made, so I did it at some point. So let's get into it. For South America, what I'll say just sort of quickly is that it looks like things are progressing about the same as they were last week. It does seem like, just anecdotally, it does seem that more people on the ground in Brazil are looking for a smaller crop. I don't know that we're going to go a lot smaller. We may go a little bit smaller, but I don't know that we're going to go a lot smaller than we are now, in part because if the weather trend has changed, then this should be about as bad as the crop looks. And as long as there's rain in pod filling, it seems like most places should get pretty close to trendline yields. I would still worry a bit about the north just because El Nino tends to end the rainy season a little early. That should be well past when soybeans are filling pods, but given the delays in planning early in the year, it may be that the rainy season stops before some of the soybeans enter pod filling. I don't think there would be that many of those, but for late planted and replanted soybeans, that may be a chance. But we'll talk a little bit more about that next week. This week, what I want to do is talk about UCO. So, in getting ready for this, I went through and updated all of our UCO data with the latest data, and I was a little surprised to find how much U.S. imports of UCO have grown. I'll show you the detail in a minute, but the sort of the key takeaway from today's webinar really is that if UCO imports were to continue at the pace that we saw in October, which was 480 something million pounds, nearly 500 million pounds, we could add another 1.5 billion pounds onto our imports, our import forecast. And that would seem like it would make sense at this point, given the increase in Chinese shipments and the increase in the number of countries that are shipping UCO to us. However, if I do that, then I actually have a hard time sort of distributing it all. So I tried to do that and then tried to cram as much UCO into every renewable diesel producer that we think uses it, and couldn't even come close to the totals. So for the moment, what we're doing is we're not increasing exports by as much as we could. And we probably will come back and adjust later. But given what looks like enough supply of low CI feedstock to meet the demand, at least through 2024, or the growth in demand, at least through 2024, suggests that the tightness that we've seen in the feedstock markets over the last 2 years, even though they weren't that tight, the price reaction to the expected tightness, I guess is what I should say, is probably coming to an end. And if, and that's relatively easy to say, we're 50% down on soybean oil futures. But I think the question is, where does it stop? And so we'll go through it, but if US imports of UCO can really be 500 million pounds a month, then that may suggest that that soybean oil prices and broadly feedstock prices will go back down to or very close to the levels that they started at before all of this. I don't really think that that's necessarily true because there is so much more demand. And in order to attract imports, you have to keep prices at a level that attracts imports. However, UCO is a little bit of a different commodity because it's used cooking oil. There is certainly competition from the European market, and that's a lucrative market. But outside of Europe, the US is really the most valuable market and maybe more valuable than Europe anyway. It looks like it's more valuable than Europe anyway. And so even if prices do come down, they still probably will be above, in the US, they'll probably be above where they are in most other parts of the world. So even if prices come down, we may still continue to attract imports. Anyway, so again, key takeaway is that I think this idea has the potential to change our bias for where prices are going to go. Now, again, not entirely 100% sure exactly where that's going to settle out, but it would suggest that we lower our price forecast broadly across the board by 5 cents or 10 cents, basically. So anyway, let's get into it. All right. So here is our estimate for monthly domestic UCO and yellow grease collection. You can see we are expecting just a small increase in the combined collection in 23-24 from 22-23, which was actually, I think, a little lower than the prior year, or maybe that was something else. This part, it looks like the consumer remains strong, and even to the extent that the US consumer is getting sort of tapped out, they still, it makes me sound like an old man, the younger generation still seem to prefer experiences like eating out over goods. And so to the extent that the economy is slowing, it probably means less for eating out than it does for some other things. And so we would expect that UCO production collection would be relatively close to last year. And we'll kind of stick with that probably until it starts to look like that's just not true. So I don't think there's a lot of big news here. The main thing that I would sort of note here is that if imports are going to be 500 million pounds, and that's about equal to production, that is a pretty significant deal. And that's actually the volume of production for UCO and yellow grease, and the imports I'm talking about are just UCO. So not that we imported a ton of yellow grease, we don't import any really, but still it's the UCO imports are substantial and potentially will change the outlook. And so what do we use it up for? Of course, it's biomass-based diesel, and this is our prediction of biomass-based diesel usage. One thing that I did while I was trying to sort of cram all this UCO into renewable diesel production is I offset the increases in our UCO usage with decreases in other feedstocks. So when we add a pound to UCO, we have to subtract the pound from someplace, even though it doesn't quite exactly work out like that because there's different yields. But when I was doing that, I was thinking about a lot of times I was taking away soybean oil because we use soybean oil as a replacement when we think there aren't enough there isn't enough of the other feedstocks to meet the demand. So we have a lot of a lot of soybean oil usage that isn't necessarily something that the company has announced or that we initially thought that they would need to use as a feedstock. But as we tried to sort of spread the feedstocks out over the last couple of years, and it's been really, really tough, we've just added soybean oil or canola oil wherever we needed to and wherever we thought it made sense from a geographical perspective. So while I was sort of adding UCO and subtracting away soybean oil, it occurred to me that we might get to the point here in the next couple of years where UCO is actually the most commonly used feedstock. And at 797, that's not super far behind soybean oil. Soybean oil is about 1.2 billion pounds right now compared to 800 million, our prediction of 800 million for UCO. If the imports are going to stay at 500 million pounds and there is a spot to use that in renewable diesel production, then it could be that that UCO becomes the most commonly used feedstock, and particularly if prices continue to trade where they have been trading recently, which is a relatively wide discount to soybean oil, surprisingly. Now, of course, the switch to the Inflation Reduction Act credit is going to exacerbate these trends. And if there is, if there is a spot where I would be more confident to predict that UCO will become the most commonly used feedstock, it would be after that switch over to the Inflation Reduction Act credit. Based on our analysis and the average CI score under the LCFS program for soybean oil and UCO and the rest of the feedstocks, it looks like the IRA credit will reduce the revenue for renewable diesel producers using UCO by about 40 cents a gallon. So a decline from $1 a gallon under the blender's tax credit to 60 cents a gallon under the Inflation Reduction Act credit. While the exact number will depend on the final CI score, that CI score will be the same for everybody. So the way the IRA credit will work is the IRS will actually publish a list of feedstock and then what their CI score is. And so everybody is going to get whatever the CI score is, which probably will be sort of around the average. But if they use the average, 60 cents for UCO. For soybean oil, given the CI scores that are around 50, which is the cutoff for the Inflation Reduction Act, it looks like there will be a very minimal credit or no credit, no revenue from the IRA credit for soybean oil. Canola oil is very similar. And so in theory, and sort of like we've talked about, that should shift feedstock demand away from soybean oil. Now, if we have this huge supply of UCO, that doesn't necessarily present a problem. We'll just use UCO instead of soybean oil. There'll be enough soybean oil to meet all of the non-biofuel demand and enough to actually increase exports. So this week, I actually increased our exports for not 23-20 or I don't think for 23-24, but I think for 24-25 and 25-26, I raised them back up to almost 1 billion pounds. I don't necessarily think that that is where we'll end up by the time we get out there, but it does highlight the idea that it highlights this change from the last couple of years where we basically have been trying to figure out how to source enough feedstock to meet all of the demand, to trying to figure out what to do with all the feedstock and how do we allocate that. So while this is our forecast now, the import analysis will have a lot of impact on where this number ultimately ends up, and it could end up significantly higher if our expectations for US UCO imports were to rise. Now, here we have a little bit of a mismatch where you can see the EIA reported, or well, based on the EIA data, we estimated that usage in October was roughly 670 million pounds. And then you can see in November and December, it's slightly lower than that. Typically, I think you would expect that one of those months would probably be higher. And this this issue is not as exaggerated as it is in tallow. Let me show you this is what tallow looks like. And so this is the October tallow use. You can see it remained really, really strong and well above our forecast going forward. In tallow, we have a little bit of a different problem where it's hard for us to allocate the tallow. As much tallow as the EIA is reporting gets used every month. It's hard for us to replicate that. But we don't have sort of the supply overhang problem with tallow. We just have this is what they say that we're using. Where does all of that come from? And the one thing that I highlighted on here, if you just look at inedible tallow, so if you keep all of the biomass-based diesel feedstock demand confined to inedible tallow, and you run the balance sheet, you run all of the balance sheet through inedible tallow, or all the feedstock demand through the inedible tallow balance sheet, then the implied domestic non-biofuel use for August dropped to negative 30 million pounds, and then for September it dropped to negative 75 million pounds, which we get negative numbers in the implied domestic non-biofuel use, particularly for things like UCO and yellow grease, where there isn't necessarily a real strong demand for those commodities, or at least not currently, from oleochemical or food manufacturing or these others. So it's the residual non-biofuel use is the remainder of everything in the balance sheet. So beginning stocks plus production plus imports minus domestic use, or minus exports minus non-bio or minus biofuel feedstock demand, whatever is left over is what we get for non-biofuel use. It's not like it's a reported number. So seeing a negative sometimes doesn't really bother me that much. However, for tallow, there is strong demand from the oleochemical industry, and non-biofuel use has been relatively steady and looked reasonable up until we hit August. Now, if we combine the three categories of tallow together, which I'm not 100% sure is the way that it's supposed to be done. It may just be combine inedible with edible. But actually, if we do that, we still end up not with implied non-biofuel use that still is not correct or doesn't seem plausible. However, if we add inedible, edible, and technical up, then we at least get a reasonable number, or a number that's positive. And that is 160 million pounds in August, still down, substantially from the prior month, but at least it's a positive number. And I say that just to kind of say that for a lot of this stuff, doing the balance sheet on a monthly basis is relatively easy. For UCO and tallow, and particularly with the growth in renewable diesel demand, it's a little trickier to figure out where everything comes from and where everything goes. There are some things like soybean oil, we get data from USDA, and so figuring it out in the interim isn't necessarily that daunting. But for UCO in particular, where we don't really take the USDA's numbers for anything except, well, we take the Census Bureau numbers for trade and the EIA. Well, we don't even take the EIA data for feedstock demand. The rest of the numbers we adjust because we don't think that the USDA reported number necessarily reflects what's going on, primarily because it's just hard to get all the numbers to work if you use their production number. And so because of that, a negative non-biofuel number in UCO is not the worst thing, but it is tough to it's tough to imagine that we are going to import 1.5 billion pounds of UCO just for use in domestic non-biofuel. there may come a point when that is what happens. And I know that there are startups that are working on using used cooking oil in non-biofuel ways. So it may be that one day that's true, but right now it's not. And so that is also why, even though the pace of imports looks like it would support a bigger increase than we've made, we don't want to, because just dumping it into non-biofuel use, I don't think is necessarily going to reflect what we actually see, or what the market is actually experiencing in terms of non-biofuel use. All right, so here is our forecast for imports. Again, you can see 483 in October, and then we've got it going down, and this is after we increased it, actually. We've got it drop into 200 million in November and December. That may be the total, but I'll be a little surprised if it is. Again, in part because for a lot of the really major trading partners with the US, they have increased their shipments to the US, or increased the volume of shipments to the US pretty dramatically. Then on top of that, just the number of countries shipping UCO to the US has exploded in the past year. So it used to basically be Canada that would ship to us. And over the last year or two, you've seen a big increase from China, a big increase from Brazil, a big increase from anybody that really has sort of put the logistics together to export UCO. I don't know necessarily where we're going to end up on UCO imports. This is sort of the first step in trying to figure out where we actually really want to be. Right now, if I could just make all of the numbers work, I would raise US UCO imports, maybe not all the way to 500 million pounds a month, but probably something closer to 400 million pounds a month. And that would be about 5 billion pounds of imports. And then we'd have plenty of supply to do whatever we needed to do with feedstock demand, and then whatever was left over would just dump into non-biofuel use. And it may be that that's sort of where we end up at the end of the marketing year anyway, but it's difficult to predict that early. So I was just talking about where it all comes from. You can see the shift in the portion of the total represented by Canada and Australia, essentially, now to where China is essentially the largest supplier, both by volume and as a percent of the total. And it could be that if China can export a lot more to the US, that the numbers will be significantly higher than we're forecasting. Right now for 23-24, we predict that they'll ship in about 1.2 billion pounds. But again, that could be another billion pounds higher pretty easily. If you look at Chinese exports of UCO in 2022-23, I think is the way that I did it. They exported, I thought I put it in the total. I think they exported like 2.3 or 2.4 billion pounds. Maybe it's on the next slide. So in theory, they could increase their shipments to the US by that volume, and it wouldn't necessarily have a significant impact on their total collections. It would obviously have an impact on who they're shipping to. And if you look back, particularly over the last year or so, what you can see is China shipped a lot to Europe. Let me do this one first. So the blue lines are Europe, and then the red lines are shipments to the US. So you can see no shipments to the US not no, but very, very small shipments to the US until late 2022. And everybody knows about the two cargoes last spring that may or may not have gotten turned around at the port that were supposed to be Chinese UCO, but were maybe something else. Either way, that's not where we are now, and you can see that U.S. shipments or U.S. demand is starting to crowd out European demand. Part of that might be because the Europeans ultimately, Chinese material was so inexpensive, they didn't really feel like it was necessarily fair. I don't know that they've done anything formally. I looked the other day to see if they had done anything formally, and I didn't see anything. Doesn't mean nothing has happened. But either way, China has shipped less to Europe and a lot more to the US over the past year or so. So while they have 2.2 billion pounds right now, and in theory, I could make an argument that would suggest that they ship that much to the US in 23, 24. The reality of it is that what we expect from Chinese UCO collections over the long term, and the portion of that that gets shipped out to the US, is sort of a steady state for US shipments of about 1.6 billion pounds. That's our forecast right now. So you can see if we're predicting 1.1 billion pounds for 23, 24, and in theory, we could add another 1 or 1.5 billion pounds onto that, almost just shipments from China, that it may be that our 1.6 billion pound number is too pessimistic as well. And China may be able to increase their collections pretty substantially. In fact, I would imagine that the 2.2 billion pounds is just where they've gotten to in their collections in recent years, and that they can probably increase that by a multiple of that number. I would think if the U.S. produces about 5.5 billion pounds of UCO a year, China should produce at least that much, and probably again some multiple of that. All right, let me go back and look at the slides that outside of the growth of China, the other thing to note here is how much the other countries have grown. So Australia has gone from, shipping less than 100,000 tons to, well, that's actually probably 100 million pounds, to 200 and almost 260 million last year. We've got them down a little bit this year, but that probably will grow, and that's the pattern for most of the countries. Canada, while their portion of the total has shrunk, the volumes have continued to grow relatively slowly compared to the other countries. But again, they were already a mature market that was already exporting a lot of UCO to the US. And so that the slow increase in their volumes isn't necessarily surprising, and neither is the decrease in the portion that they provide of the total. If you think about it, Canada is a great UCO partner because they're so close, and they're an advanced economy, so their consumer preferences will have built that industry on some level anyway. But it's not a big, there's not 300 million people living in Canada, and so UCO production is probably, or UCO collection in Canada is probably maxed out or relatively close to being maxed out. And so the growth in Canada, the volumes will be relatively slow, and that will continue to shrink their portion because of growth in China and the other countries. All right, so outside of China, where does outside of the US, where does China ship UCO to? This one should have been the last one. And again, you can see that in 2022, they really shipped a lot of UCO to the European market. But in 2023, at least the first 11 months of 2023, the US shipments really crowded out supplies going to Europe, which suggests that probably the US market is the more valuable market of the two. Otherwise, they would have just kept shipping whatever to Europe, and they would have shipped more to the US, but it would have grown, one, not at the expense of Europe, and two, it would have grown more slowly than it has in the past year. Singapore continues to rise, although the growth there is sort of along the lines of increases in population and economy. Other than outside of Asia, excluding Singapore, relatively steady. Not much into Africa, other Europe, or I think almost zero into the former Soviet Union. Okay, so here's our balance sheet for UCO and yellow grease combined. So I'm sorry, I said 5.5 million pounds of UCO production. That's not right. It's really like 4 million, I think, or 4 billion in our just UCO balance sheet. So 5.5 is the combined. You see growth in almost every category of demand. The only one that shrinks during the forecast period is for biomass-based diesel. That really may ultimately not be true as well. In fact, it's far more likely that we will allocate an increasing portion of UCO supplies to biodiesel demand as a replacement for soybean oil. If the biodiesel producers are going to survive the transition from the blender's tax credit to the Inflation Reduction Act credit, they are going to have to nearly get rid of soybean oil. Now, I know in the past I've kind of said that the elimination of soybean oil as a feedstock for either biodiesel or renewable diesel producers is something that I don't think would necessarily work. And I continued to think that right up until I saw the UCO import data. And so if that is the supply, then it doesn't necessarily mean that that we are going to be so tight on these other things that is going to mean that we don't necessarily need to use that soybean oil for biodiesel production. And in that case, then you also don't need a huge rally in RIN prices. LCFS credit prices are going to adjust to the changes that CARB makes this season. But if we get so many UCO imports in, again, it suggests that prices potentially could go back to sort of the levels we saw before all this started. So for soybeans, that's like 32 cents. I think for UCO, it was like 20 cents. I don't know, and certainly we're not forecasting that we're going to get down that low right now. But I'm just saying there is a non-zero chance that we do forecast that low. And I would say that as we go through and get deeper into this analysis and get a couple more data points, there is a chance that that our forecast ultimately will do that. Now, the one thing that is a little confusing about our price forecast currently is that despite everything that I've just said, if you look at, and I'll show you our UCO forecast here in just a second. If you look at our UCO forecast, it predicts steady price increases throughout the year. And if we really are going to import 500 million pounds of UCO and we don't have to worry about tightness in feedstock markets anymore, then that doesn't make any sense. So I'm struggling with this a little bit because while I can tell a bearish story for feedstock supplies, and I can tell a bearish story for from the perspective of world vegetable oil fundamentals, U.S. fundamentals remain extraordinarily bullish with stocks dropping in the latest fats and oils report to the lowest level ever in that report, and lower than last month. And based on our estimates from before we had the fats and oils report, it looks like December 2014 was probably the closest we've been to the current level on soybean oil stocks. So while we have this going on one hand, for soybean oil, we have fundamentals in domestic fundamentals that are wildly bullish. Now, the combination of those two should, in theory, mean that soybean oil futures are screaming higher, and soybean oil cash prices and low CI feedstock cash prices are moving lower. And the only part of that we don't see is necessarily as futures rising. And that in and of itself, and there's a couple of reasons for that we've talked about, the soybean meal demand and spreading and that kind of stuff. So theoretically, soybean futures could be a little bit, or soybean oil futures could be a little bit higher than they are right now, given everything else just sort of staying the same. If you just liquidated the spreads, the oil share trades, you probably would have soybean oil price a little bit higher. But not, I mean, the 90 cents reflected the tightest stocks since 2015. The current level doesn't necessarily do that. You can say that that the market's anticipatory, and so the 90 cents was a worry about where we are now, and today's prices are reflecting what's going to happen with the Brazilian crop and world supplies going forward. And that may be true. And it may be true that it also has something to do with the UCO imports, the volume of UCO imports. That's, I'm sure, also weighing on feedstock prices. All of that said, you do have sort of these bullish fundamentals that it seems like we probably need to factor in into prices somehow. But okay. So here is our forecast. There's a big gap between where the historical data ends and where our forecast begins, because the average price last month was so much higher than where UCO is currently trading, and higher than our forecast for December. But you can see we have it going up relatively steadily through the year and getting back above 50 cents by the end of the year. I really, I thought a lot about what I wanted to say here and how I wanted to do this chart, and I really never came up with a great explanation. The initial idea behind the rising low CI feedstocks, and as you'll see when we post our reports today, we have most of the low CI feedstock fat and grease prices. Our forecasts are mostly look a lot like UCO to some degree or another. There are some that don't go up quite as quickly, whatever, but they generally, we expected low CI prices to be supported in 2024 because we were getting close to using up all of the sort of excess demand, all of the demand that was all of the excess supply, all of the supply that was left over after exports and non-biofuel use. If we consume all of that supply, given the fact that most of the low CI feedstocks have a relatively fixed supply, so we're not killing more cows to produce more tallow, we're not making actually more French fries to make more UCO. And so if we are consuming all of that excess supply in biomass-based diesel production, then that in and of itself should support prices. The UCO imports throw a big monkey wrench into that. And so if we just were looking at UCO imports and you just dropped me into the seat today, my price forecast would probably look a bit different. I don't know that I don't know that I'm ready to go sort of full just down and to the right, but I'm certainly leaning a lot closer to doing that than I am to continuing to have the forecast look like this. The other reason that the forecasts look like this is because when we look at the spreads, we had made a decision that we thought the spreads were going to narrow this year. And so if that's true, just all else equal, if our soybean oil forecast is relatively flat for the next year, which it is, and you have the spreads narrowed, then that means that implies that fat and grease prices move higher. I still think that the spread is going to narrow. how much and how much more is a little hard to guess. If the fundamentals play out, the spread should actually widen. The premium for soybean oil should increase because soybean oil is the most has the most bullish fundamentals. But it's not quite there yet, and I don't really have an outlook for prices that I really feel confident about, that I just want to beat the table on. I still feel confident that a large Brazilian crop is going to weigh on soybean futures, and that's ultimately going to weigh on soybean oil prices. I haven't changed my thoughts on that at all. But it's the impact of these UCO imports and of this idea that maybe, even though we were getting close to consuming all of the excess supply of fats and greases. And that had supported prices that now that's not even a problem at all, because we've got so much UCO and theoretically more tallow each year. So I wanted to show this, and I wanted to talk about it a little bit. Don't be surprised if you see some significant changes in this forecast in the coming weeks. I think the fairest guess at where the forecast would be, just again, if I started the job today, it would probably just be flat around the current level with whatever seasonal variation you see in UCO prices. That's kind of what I would guess. That's kind of my baseline guess, and that would imply then lower soybean oil prices, which again may make sense if you look at the spread between soybean oil and palm oil, where palm oil is trading right now relative to soybean oil suggests that our forecast for soybean oil is too high as well. So I think there's a good chance that our soybean oil price forecast comes down a little bit. Just again, trying to figure out exactly by how much and how much this is going to impact everything. When that happens, even if I don't change any of the fat and grease forecasts, they will just come down naturally in reaction to the lower soybean oil prices. But I probably will take a deeper look at those spreads and try and figure out exactly where I want them to be from that perspective, and then change the forecasts. But it's unlikely that the next forecast for UCO prices will look exactly like this one. And that line is actually, I knew that we had predicted higher prices, and I looked at them. It didn't look to me like the line was so steeply tilted upwards. I thought that we were a little more gradual than that. And maybe it's the scaling, I don't know, but that seems like an aggressive increase in prices, no matter what the fundamentals are, unless we're, back in 2020. All right, I just had to put my favorite chart up again and talk a little bit about what the fats and oils report showed. First, it showed that soybean meal demand was even stronger than implied by the NOPA data, in part because soybean meal stocks had gotten so tight at the end of November. So if NOPA doesn't give you soybean meal stocks data, so every month when it comes out, we sort of have to guess at what we think the stocks are going to be, or what the stocks were at the end of that month. If you look back historically and look back at the month-to-month changes, it's actually, you can get relatively close most of the time just by guessing. However, this month we were off by more than we usually are because of a bigger drop in soybean meal stocks, which meant that domestic consumption was higher than our expectation. It looks like the strength in meal demand is going to continue. We base our meal demand forecasts on our slaughter forecasts. However, I've actually raised some of these relative to our slaughter forecast, just because demand has remained so strong. And if anything, the lower prices that we've seen over the last couple of months are only going to continue to encourage the domestic use of soybean meal. it still does seem likely that that we will crush more. There still is a possibility that crushers ultimately end up crushing for oil, and then we crush excess soybean meal that needs to find a home in the export market. However, that seems, given the UCO imports, that seems less likely today than it did for the last couple of years, actually. And I don't know, well, I should say in the short term, it seems much less likely today than it has over the last couple of years. In the longer term, it still seems like almost a virtual certainty. However, again, if China has 15 billion pounds of used cooking oil to export, and they do, then the pressure is off soybean oil, and oil share probably drops to 32% or something. And oil prices probably remain under pressure, and crushers continue to crush for meal. So meal demand is a critical factor in looking at prices. And of the fundamentals for soybean oil, I would say meal demand, which ultimately controls crushing volumes, is probably the most bearish data point you can find for the outlook for soybean oil prices. However, if you look at soybean oil itself, and I know this is a busy chart and I apologize. If you look at soybean oil itself, the fundamentals have gotten to be, like I said, as bullish as I've seen in a long time, and certainly a lot more bullish than we've seen over the last 2 years. Now, this is going to be this isn't super straightforward. I wanted to actually put in a chart of the chart of our prediction of US soybean oil stocks, but I hadn't completely cleaned up soybean oil going out in the longer term, and stocks just kept rising. So they went up to, I don't know, 25 billion pounds or something. And that's because of all of the demand that I've taken out of soybean oil to add UCO to it based on the import demand. So I showed this, and the purple line actually shows days of coverage, which is essentially the demand for the next month divided by the number of days in the next month to get the average daily use, and then comparing ending stocks for the previous month to that month's demand to figure out, if we quit producing soybean oil on the first of that month, how many days would we get into the month before we ran out of soybean oil completely. So you can see in October, that number dropped down to the lowest it's been in a very, very long time. And in November, it looks like it rose, even though soybean oil stocks actually dropped in November. And the reason is that we don't have the same level of demand for November that we had in October. And so even though they've gotten tighter relative to demand, or at least our prediction of demand right now, they actually have gotten a little bit looser from a days of coverage perspective. Now, days of coverage is not something that a lot of people look at. And so I think more people will just look at the stocks number and say, holy cow, that's a low number, than they will at the days of coverage. And again, from that perspective, it's hard to argue that soybean oil prices should be lower. However, that's what we've seen, and again, maybe the UCO imports and the tallow imports and the fundamentals of the fats and greases are what really are, in addition to sort of the spreading, but are what are really driving soybean oil prices. And if that's the case, it does seem like the market has gotten it right, and got it right a lot earlier than I did. I've got to say the UCO import thing is something that I think probably should have been. I feel like I should have figured this out a little while ago. Okay, last chart, and then I'll answer a question that somebody has so kindly typed. You can see basically we have inedible tallow and DCO as premium to soybean oil in the coming year. The green line is UCO, and so for as aggressive as the line looked on the price chart, it looks less aggressive here and is not as aggressive as some of the other commodities, some of the other fat and grease commodities. I put this up primarily to just say one thing, which is that over the December and I think November, everything was premium to, or soybean oil was premium to everything. We have DCO and UCO, or DCO and tallow trading at a premium to soybean oil. The tallow thing is just a demand thing. So the strength in demand in tallow is what we think drives that price below or above soybean oil. For DCO, it's a little bit of demand, although again, I think that UCO will substitute for DCO just fine. It's also a little bit of maybe slower production of ethanol than we've had in the past. I recently did the ethanol data. I don't know that I'm going to ride that one too long because it looks like ethanol production is coming back, and it also looks like yields are a little bit higher than they have been. And so DCO supplies may mean that ultimately I revise that and maintain the premium for soybean oil to distillers corn oil. All right, let me get to the question that somebody so kindly asked. All right. Do you see any potential for traceability to affect imported UCO volumes? Yeah, absolutely. So last year at our conference in May, which I encourage everybody to attend, that was the first year that I really saw a lot of the traceability companies at our conference. Now, maybe they've been coming for years and years, but I just didn't know because I never really talked to any of them. And I happened to have a former colleague, somebody that I've known actually for a really long time, that had gotten a new job at one of the traceability companies. And so he was at our conference last year, and so maybe it was just more, maybe I was just more aware of the traceability companies at our conference last year. However, I think that it's more likely that the growth in the traceability companies at our conferences was a response to the increase in volume in UCO imports and the anecdotal stories about ships getting turned around at the port. I do think that it is a requirement, one, so that renewable diesel producers can be confident that what they're getting is actually UCO and that it doesn't come from some source that the producer wouldn't want it to come from. And I think that there probably will be a little bit of a battle between the traceability companies until one emerges as the sort of industry standard. So it may be that we have traceability companies, they're working and they're doing everything, but we don't see the impact on import volumes until the industry settles on who they trust the most, essentially, for traceability. And once that happens, then you can see an acceleration in import volumes. Now, maybe it'll just be that they'll split the market up between themselves, and everybody will trust all of them equally, and there won't be any delay in the increase in UCO imports. But I think that if you think back to the chart that I showed with Chinese shipments to Europe and then Chinese shipments to the US, the growth in US shipments, I think, is probably a function on some level of the traceability efforts. I don't think that you would have seen that same growth if those traceability companies don't exist. And so I think that traceability is critical for UCO. I also think that it has the potential, maybe in the US, to increase the volume of palm oil that is used in biomass-based diesel production. because with palm oil, it's not as much the oil as it is concerns about the impact the oil has on the environment, primarily deforestation to increase the size of palm oil plantations. And back in the early 2000s, burning of the peat bogs in Indonesia actually used to cause such huge clouds of smoke that people in surrounding countries, Singapore and in Malaysia, would complain about it. And so they got tough and sort of cut that out, but there still are a lot of questions, and traceability is the answer to a lot of those questions. So I think that not only will it help or continue to help support UCO imports, but I also think that as the industry gets more comfortable with it, it also could expand into palm oil and potentially help with that as well. This past the latest data from the EIA on feedstock demand, there's a category for other vegetable oils that they report, and they usually report it as a W withheld to prevent from disclosing the data for a single or a small number of companies. So typically that category is a W. Last month, or the last report at the end of December, I think was the first month, and it might have been the second or third, but relatively recently we've seen some growth in that, so that it's not just a W, and it actually went from like 4 to 7 to 16 or something. And so there's some growth there. And when I saw that, I kind of thought about the traceability thing, because that in the footnotes, they say that that category includes palm oil. And I thought, oh, maybe people are starting to use palm oil. We've imported a lot more palm oil than we used to. And what I thought was kind of like, well, if the traceability thing works for UCO, maybe it works for palm oil too. And maybe that's why we're starting to see some production right now. And maybe we'll start to see more palm oil and more biomass-based diesel produced out of palm oil in the US going forward. Could you talk more about the impact that traceability could have on the volume of Chinese UCO imports? So I think I covered that. If not, send me an email and we can talk in person about it. I think it's more critical for Chinese imports than almost any place else, and I say that mostly because of the anecdotal reports, not to cast aspersions on anybody, but I do think that sort of because of those reports, probably the number of buyers that would just buy Chinese UCO without traceability are probably pretty few and far between. And so I think as important as traceability is probably for all feedstocks, and especially as CI scores become more important in credit valuations, knowing exactly where that feedstock came from is going to be increasingly important. However important it is for all of that stuff, you could add all of those together and double them or triple them, and it wouldn't even come close to the amount of importance that it is for Chinese UCO imports into the US. Because without those, I just am not sure that sort of the old, you hear the jokes about where Chinese UCO comes from, and those jokes are made because there's uncertainty about the sourcing of Chinese UCO, and so traceability is going to be a key. Of course, the odd thing is that ultimately you have to trust the traceability company. So if you don't have a traceability company that you trust, then it doesn't really make that much difference. But if you do have a traceability company that you trust, then it can have an impact. And I assume the traceability companies that have been set up do a fantastic job. I don't, like I said, I have a former colleague. He works in sales in one of them, so I don't really even know that, excuse me, that much about what they're doing, other than tracing the source of UCO. But I still think that it's really, really critical. And again, it may be that what they're doing it's just sort of self-evident that they aren't kind of messing around with the sources, although I don't know how that would ever work out. Anyway, thank you so much for the fantastic questions. Thank you, everybody, for showing up. I know that today might not have been the easiest day to get in here. Just please remember next week, if you don't get an email, click on one of the old links and that should bring you back here. If not, we will double time on trying to get it fixed so that you do get emails going forward. So hopefully by next week it'll be fixed and you'll get an email. If not, please click on an old link and you should be able to get here from one of the old links. All right. Have a great week, everybody. Thanks. Bye-bye.